get a read on the commodities space right now. Jonathan Barratt, Managing Director of Commodity Broking Services, joining us from our Sydney City studio. We've got Peter Maguire from CWA Global Markets also with me in studio, and Carson Scott. Starting with you though, Jonathan, great to have you on board. Chinese data today, anything going to particularly catch your eye, or in terms of when you're looking at forecasts and where to put money across this market, what's important?
Look, I think it's generally across the board, Brooke. When you look at it, you want to see how IP goes. You want to see industrial production. You want to see growth continuing. What I also think you need to see is you want to see a backup from the reports that the IMF have told us concerning growth in China. So when you look at that, you want to see that whole story, that whole recovery story, or that moving or that momentum continuing, because if that momentum continues, then that will only help our resources and primary imports, which will help our economy and our market to pick up.
You talk about momentum there, Jonathan. Isn't it rather curious that it seems that the IMF is always scurrying to revise their projections as often as you and I change our underwear, it would almost seem. You know, how much store do you place on that body's forecasts?
Well, look, I think you've got to. I think there's a couple of things that come to it when you look at forecasting. You've got to make sure that obviously all the numbers stack up, and that the market, you've got to create that confidence. And I think what we're lacking is that confidence in the market. The IMF, they've got some pretty smart people there, and when you do see what's happening in terms of growth around the world, particularly out of India and China, that's the story that Australia's hitched its bandwagon to. So I've always got to be optimistic that they're going to do what they're going to say, and if that's the case, then these numbers out of China should be okay. Although we know they're slowing down a bit, but as long as the average is okay, then that's got to be good for us.
Peter Maguire from CWA, agree or disagree?
Good morning, Jonathan. Yes, I agree. Hello, how are you? Good to see you. A couple of quick things. First off, I think if we're under 10%, then as far as GDP growth for China, that could show a little bit of a little nervousness. But I think overall, we've got some very, very strong numbers ahead over the coming years. And, you know, these are just minor hiccups. We've seen a big sell-off in iron ore prices as been demonstrated in the last couple of weeks. Do you see a rebound in that market?
Look, that's going to be quite interesting, and when you look at the, I guess when we look at the iron ore imports and iron ore prices, they are under pressure. But I think one of the keys here that we've all got to look at is the freight rates. And we're a bit concerned because the freight rates continue to be drastically low and have been under pressure for the last 2 to 3 months. In fact, the Baltic Dry Index is around about that 1900. That does concern me on any recovery. And I think when you see an iron ore prices on their lows, you want to see a pickup in the freight rate. You want to see a pickup in those prices to ensure that we have that recovery. Remember also in China, we're chewing through a lot of stock, and that might be another reason. Well,
I wanted to ask you two components to that. One, people were saying Baltic Dry at this point in time should not just be read in the conventional way, because
yes,
a lot of the ships and our new ships are being commissioned. Until that happens, there's kind of a little bit of a delay, and that's skewing numbers. Do you agree with that one, Pete?
Absolutely. Huge shipbuilding over the last couple of years, Jonathan.
Yeah, okay, so that's one factor. Now, you talk also, Jonathan, about, you know, just, I guess, stuff on the ground. People say this is summertime in China, Pete. You've got excess iron ore just sitting around, literally kind of just piling up. You can't expect Shanghai to chew through that in 5 minutes, let alone anywhere else.
Well, that's right. It's been very, very strong growth in exports from here over the last couple of years. So, you know, we've done well, and maybe it's just a little bit of a time to those inventories to come back down, and then possibly later in the year with cheaper prices.
Because you're looking at the... sorry, go for it, Jonathan, go.
Yeah, just also on that point, I mean, we know that inventories will come down, and we're expecting growth, but we're expecting growth to sort of temper off a little bit. We've seen it obviously with the numbers in real estate in China. But one thing I think which we've got to look at is the currency policy, how the yuan will appreciate and how that will make things more attractive for imports. Now, these are all expectations that's happening. So I think when we look at those forecasts, we've got to look at how the yuan will appreciate and how that will stimulate those export and those prices. So I'm keeping a close eye on any rumour or any talk about the appreciation of the yuan, because I feel that that will be where growth could commence from.
But do you think there is actually a commitment to increase the yuan that much?
Oh, look, I think the fact that we've moved into more of a less of a control in terms of the appreciation of the yuan signals to me that they're actually going to use that as part of the balancing equation for growth. So if growth starts to come under pressure in China, then you'll see that they will allow the currency to appreciate a little bit more, and that will actually help smooth that growth curve which we're looking for.
Can I just get, Pete, your view on demand? You talked about just before long-term price action only really going one way. You know, and my question to you was Treasury forecast yesterday here, and this is all about our budget and what's coming into the coffers, saying there's going to be a pullback between 2012-13 and indeed out to 2013-14.
Could well be. I mean, you know, when you see the price, we bought a graph in, and just to show you, you know, it was at $185, and now it's sitting under $120. I don't know whether that'll come up, but
no, it probably won't.
But the reality is, you know, you've seen such a huge sell-off, and if you even talk about the Baltic Dry Freight Index overnight, that was off 5%. So it's the overall picture. We're sure we'll see continued growth, export-driven, but we're not sure actual price.
Just brief final thought before we back to you. I mean, does that leave the government's credibility in tatters, though? If it says we'll get back into surplus, but it then says commodity prices that we're basing that on are going to go backwards in the very years we get into surplus, hello?
Exactly. Well, I mean, Australia hasn't got a monopoly on iron ore. There are other producers in the world, and as the years go on, I'm sure that those particular mines will come into action. And if they can beat us to the punch as far as price, then it'll be a more competitive market.
Yeah, and it does. And Jonathan, it does seem at the moment there's a lot of projects in Australia just waiting to get the green light. Kind of maybe they're a bit at loggerheads with the government, political.
And Mongolia as well. I mean, huge reserves up there. So there are other parts of the world, Brooke, that have got wonderful reserves. All through Kazakhstan, we talk about iron ore, and certainly across all base metals. And have a think about Afghanistan as well. So there's huge pools of resources all across that whole area.
Jonathan Barratt, do you want to weigh in here as well?
Oh, look, I think there is, but I also need to see that growth occur, because one thing you do find is if supply picks up, prices go down. And what we are seeing, if you try and you've got that long-term perspective, but I think more in the short term, you look at that supply at the moment and inventories across the world are actually coming under pressure. And I think the argument which we've got to try and bring back in is where will prices go in the next 6 months to 12 months, not next 5 years or so, because we know that economies will come out of this. But I think what a lot of investors want to try and work on is say, hey, where are we going in 5 months? Where are we going in 6 months?
Okay, Jonathan, speaking of that time frame then, let's get your call on gold in that time frame. It's the one commodity that has shown at least stability, not stellar rises, but what are you calling for 6 months?
Well, I tell you, it is good because at the moment gold is, if you can put a chart up and have a look, you've got a very strong support which came in from that move from 700. That support comes in around about 1180, 1185. If you look at the range from 1180, 85 up to 1265, we're at the lower end. I'd probably expect, given where we are, for it to go back to 1240. If we start to get retail sales and retail prices picking up, a little bit of inflationary pressures, then that will help me move through that 1265. I really need to see the economies pick up in order for us to reach new highs. But at the moment, we're happy being long at these levels, and our stops are obviously below that 1180 level.
Pete?
We're the same, Jonathan. We agree, and we actually are a little bit more bullish in the sense of probably even 1350 sometime in 2010, leading forward to around about 1500 by 2012.
You're actually bearish the VIX index at the moment, which means you obviously think volatility is going to ease back. With less volatility, are people wanting things like safe havens, like gold?
Oh, well, the VIX is unique in itself because it's now under 25. Brooke, it'll probably trade down to about 22, 21, where our forecast is. We're bearish, and we expect the equity markets to move forward, and the gold price to continue along with silver.
So I'm just not getting the connection between being bullish equity markets and everything moves higher. In that kind of environment, why are you seeing gold making new highs?
US dollar coming off a little bit, euro strengthening, and uncertainty across the mature markets, and that's why it's forcing money into gold.
So what would you say? You take a bit of profit now, but maintain the long-term view on gold, the long-term bull view, but a bit of profit taking now?
Oh, it depends on the instrument you're buying. If you're buying shares, I wouldn't get out of them. If I was buying derivatives, it's a different sense because you've got time constraints. What about open interest by the end of the year then? What if you're buying open interest by year end? Because those prices are off 33% down to 1500. In what regard?
Well, when we've got the open interest to buy in at 1500 by the end of the year, that has fallen, whereas the longer-term outlook to buy out to 2011 has actually gone up.
Yeah.
Okay. Well,
I can help out on that one.
All right, shoot away.
Yeah. What you've got is that influx of new demand. The supply-demand picture for gold has always been very, very tight, okay? So the prospects as we move forward out of recovery suggest that people will go more into those exchange-traded funds, and that's where you'll probably see the growth. We've had phenomenal growth over that for some time, but then as you lead up and lead out to those forecasts, you can see that more people will move into it, and as a result of that, the supply-demand picture will favour gold, and that's why I think you'll find those long-term projections are quite solid.
And that's, if anything, more secure, is it not, rather than the ETF move it at will play?
Yep, absolutely.
Jonathan Barratt, you get the last word, I think. Thank you so much. We appreciate your time today.